morning. You're watching The Market right here in ET9 with me, Aisha Faridi, Avandabash, Nikunj Dalmia in the studios, and some consolidation. That's how we kick-started the trading week this time around. Just very, very narrow a range, but no causes of complaint. We managed to click on to that 21,400 level. Having said that, you can't really draw out any trend after the 500-point rally that we've seen in just the last two sessions. This consolidation that we saw yesterday was much relief and much welcome. So yes, you had the broader markets once again, which did outperform the benchmarks. Banks, IT, real estate stocks, all of them took a breathing. And, yesterday was more about some of those stock-specific, news-specific moves, even within the broader end of the market. So what with the move on sugar, in shipping, defense, they were the ones which were in focus.
See, Aisha, we've seen extreme of everything actually in last couple of days. A monster rally, monster momentum, extreme momentum, and then technical conditions which are stretched again, extreme in terms of overbought conditions. Now, typically when you see extremes, a big rally, lot of momentum, big bust in liquidity, and then extremes in terms of technical positioning, this is not going to last. Now, when these circumstances have happened in the past, either you've seen a pause or you've seen a sharp reversal. Now, reversal is unlikely, but a pause I think is evident. Why a pause is evident? Because large part of the rally also what we have experienced has been a function of global markets. And globally, post the Fed meeting, that one day of big move in US markets followed by a great day in Asia, we've not seen a lot of follow-up buying per se. So globally, you would say crude is up, yields are flat, equity markets in a sense are consolidating. Then the data in the F&O market also seems to be indicating that at higher level, demand and supply equation seems to be indicating that suddenly there is supply coming by by options writer. So you add all those things up, it appears to me that we are in for a pause, not a retreat, maybe some consolidation. I continue to maintain that in this kind of a market, you should shift from small cap to large cap. If you're not doing that, start raising cash. Rather than getting governed by FOMO, just don't give into that temptation of FOMO, because if you don't give in the temptation of FOMO right now, 3 months from now, you will enjoy JOMO.
So you're joy of missing out for those who are not, in sync with what the lingo is. Yeah.
So, this kind of a move, as you said, it's just a bit of a consolidation. So no need to look at this as a buying opportunity whatsoever.
No, we've seen just one day off.
Exactly.
I mean,
not even 38 points on the Sensex.
No, my point is that when you have a combination of extremes,
yes,
it's been an extreme rally or a monster rally. The bust of or the commitment by foreign institutional investors in the month of December again has been extreme. Market technicals are also extreme. This kind of a setup does not last. Now, historically, when you see this kind of an extreme positioning, it ends badly. That's what market has taught us over the years. But I don't think we are there in terms of the penultimate lap where it's going to end badly. I think we are in for a pause. In a pause, you will see a little bit of mid-air, turbulence here and there. Some sectors will come back, some sectors will go down. So take some profit off the table. It's advisable. You're making money. Yeah. Lock some gains. Enjoy. Spend some money. Go for Christmas holiday. Take a chill pill.
Yeah, and like you said, that one-day aberration, and that's what played out as well when it comes to the liquidity situation. The FII is a very mild sell figure, but a sell figure nonetheless after that mammoth spree of buying over the last few trading days, especially in the month of December. In fact, just alone, we're about, the 19th of December, and FIIs have pumped in close to 29,600 odd crore rupees. So that is pretty impressive, but yesterday a mild sell figure. But the other interesting part is the fact that the India strategy notes as well are out, and Morgan Stanley and Jefferies as well have come out with their latest notes. Morgan Stanley talking about how the Indian equities continue to outperform emerging markets, and that the absolute valuations for MSCI India are down marginally. Jefferies alluding to the fact that the economic indicator is showing that activity has slowed a bit in the month of November.
Yeah, so both the reports in a sense are just, a summary of the market positioning. I mean, it's not a tactical idea for 2024. I guess if you look at the Morgan Stanley report, it is more of what we actually know right now, which is that markets are at an all-time high. It's been a great year. Domestic institutional investors have really been the differentiating factor, and in terms of the macro and the fundamentals, we are at the right place at the right time. Jeffries, well, it's about the tone in terms of activity, where they like power. Consumption trend is resilient. Capex indications are very, very strong. So it is more like a neat summary of where we are right now. But if you have to look at the sum total of what Morgan and Jeffries are trying to indicate, all of the common thread which connects them, I think, is the fact that markets, the economy is in a good shape, capex is strong, the resilience by consumer is decent, which means as we move from 2023 to 2024, I think the attractiveness to invest in India or the resistance not to book profits into India, I think would be there. I want to look at that FDI number. I think we are ignoring the setup right now. For me, I think that will be the differentiating factor next couple of months of January 2024, because January 2024 you have this year beginning allocation impact. Now that's the December number, guys. Look at it, 29,000 YTD, and which is where Aisha Awan we need to pay focus. Now look at this number. Hello, it's a red of 18,000 crore and it's a buy of 1,75,000 crore. Now just understand the perspective here. Large part of this flows by domestic institutional investors is a function of SIPs. That SIPs ain't going to change, which means we are looking at about 12 to 13,000 crore on a monthly basis. That means 1,30,000, 1,40,000 crore will still come next year. Imagine if foreign institutional investors, if we get a reversal there and that red becomes green, then we are looking at a very different market. Suddenly from an institutional side, there would be no sellers, and which is what I think we are moving in right now. Sometimes in market there is a selling panic, sometimes in market there is a buying panic, and are we in for a buying panic in January 2024? Let's see.
Yeah, that's going to be. So yeah, FOMO for the FIIs and JOMO for the DIIs.
Exactly.
I think that's the messaging. In fact, that's exactly what Sailesh Bhan as well told us, and also talked about the themes that he's liking in the market and marking out right now: logistics, manufacturing, energy transition.
The beauty of this country is that we claim that we've seen such strong growth, but I think we are still truly having many sector opportunities which are very young. So today, leaving aside the forgotten blue chips, as I call them, the large caps which are there, you've got many sub-segments which are very young. For example, logistics as a category, though very few players exist there, but I think this is one space which post GST has become a scalable, large, all India opportunity which is possible. So this is directly available to us. Second area is, while pharmaceutical might have seemed to have done well over the last 20 years, I think the same opportunity is as young as it was maybe a decade back, because the country itself is changing, the demographics are changing, the scale itself is changing there. Within manufacturing, or I would say the energy transition, the power side, the activity levels in India could be way higher and way different in the next 7-10 years. So that is one which will throw in a lot of activity on transmission, a lot of activity on getting the real design right in terms of the power networks which we have. And that is one area where we think growth will be outlier. So these spaces do appear to be extremely attractive. And the most commonly talked about the luxury space in India, because of what's really happening in the upper end, the top 10% of India behaving exactly like how the high income countries globally behave. I think clearly that luxury market across categories, not just one space, is set to do extremely well and could become multiples of the size what it is today.
All right. By the way, just a quick check-in as to how the rest of the globe is trending this morning, and it's a little bit mixed for the Asian screen. You've got the Nikkei, which is looking a little bit choppy, but for the most part, it's a little bit of a flattish trade. Do remember, overnight you saw the US markets, which wrapped up the trading day in the green or a little bit flat, with the S&P 500 now nearly 1.2% from its all-time closing high that it hit in January of last year. But let's also connect with our chartists to find out what they make of the market setup. 21,418 is where we wrapped up yesterday. Nooresh, Merani, Kunal, Bothra joining in. Nooresh, I'm going to come to you first then. Let's get in a take as to what you made of yesterday's move, because when it came to the headline index, it was a phase of consolidation. Is there more here to stay?
So a little bit of a consolidation would be normal after such a move. We've gone up one way, we've had a few gap ups. So a pause with rather than a price correction could be possible here. So a new range could be formed between 21,200 to 21,600. So overall, the bias still remains positive. We could see some action shift more to the mid caps and the small cap names and be more selective for the next few sessions. So overall, banks continue to look promising. So one of the leading sectors from the Nifty itself, which is almost 35-40%, continues to look good. So the view remains same, continue to ride on to the trend and keep looking out for new sectoral rotations and start focusing a bit on the mid cap, small caps as well.
Right. Kunal, once again, outperformance from the broader markets. Do you see this continue while the Nifty consolidates?
Yeah, so I think there's a very high chance that we may probably consolidate on the indices, and I think that could be a period where the mid caps and small caps should ideally tend to outperform. Now, the only change of data which has happened for the index, which is not the case in the last few trading sessions, was emergence of call writers back again at the 21,500 strike for the index. And time and again we've said that at round strikes, there's bound to be a lot more heavier writing for the indices, whether it was at 21,000 where the index took a pause for 2, 3 or 4 trading sessions, and I think at 21,500 we've spent almost 2 days on the index so far. So I think in that kind of a time span, I would probably expect that next couple of days or good part of this week we would probably consolidate at 21,500 mark, and that could be a good time for the mid caps and small caps to start outperforming.
Okay, that's the view coming in when it comes to the broader markets and the market setup. So in light of this strategy, Nooresh, let's understand what exactly your stock-specific calls are.
So looking at a couple of mid caps which have started breaking out. First is about Granules India, which has slowly and steadily trended up and now has given a flag breakout yesterday. Looks like a stock which could go back to new all-time highs. A stop loss at 390, target price of 450. Second is a buy on PVR Inox, which has seen a small flag breakout and has started trending up. Expecting a short-term quick move towards 1900, 1950, stop loss at 1780.
Right. Kunal, what about your stock-specific ideas?
I'm focusing on a few high beta names. So the first one is about Indiabulls Housing. That's a stock which has confirmed a breakout above 230 mark yesterday. So it looks attractive for a setup of another at least 10 to 15% upside. 260 as a target, stop loss at 215. And Hindustan Copper is the other name which has broken past about the 190 plus mark in terms of a breakout yesterday. So it looks attractive. A cup and handle pattern on the weekly as well as on the monthly charts. Would suggest a buy with 206 as a target, stop loss at 188.
All right, there you have it, all your stock-specific strategies being flagged off by our chartists. Now, important to track as well the stocks that are in the news. So let's get straight to it then. And we've got Anisha joining in our studios to discuss just that. And it's interesting that we're talking about food straight up early in the morning. Devyani International, they operate of a KFC as well as a Pizza Hut, and they've announced that they've inked a pact with Thailand as well to take over some of their KFC outlets.
Oh, well, yes, they're looking at expanding into the international geographies as well. They do have presence in Nepal and a few other areas right now, but this would mean that they are going big into the international arena. So they are picking up stake, which is there in the Thailand KFC market through the Restaurants Development Company Limited. The acquisition has been made at an EV to sales of below 1 times FY23 earnings. And if you compare it with what Devyani itself is trading, which is close to around 8 times EV to sales, this seems quite cheap. Even on the EV EBITDA basis, it's almost at 6x. Devyani will be paying almost 340 crores as cash consideration. A part of it will also be paid by Temasek, but overall comes in as a great opportunity for Devyani International, because it will position them as a key player in the Thailand QSR market and pave way for additional growth, as I pointed out. Overall, they have 274 KFC stores in Thailand, and they have been generating revenue close to 1,200 odd crores. So a large acquisition coming in, and the first read-through suggests, Nikunj, that it's quite positive, because this time around it was a bit subdued in the Indian markets despite the festivities, but this could add as a growth trigger.
So Nisha, first you got to understand why are they looking at expanding outside India? I mean, Indian market in a sense is a very large market, and typically when you're going to another geography, that means Devyani International will have to now manage two large country risk, which is the macro in India and the macro in Thailand. Now, Indian macros we understand. Thailand is a very difficult macro environment to call. So now suddenly for Devyani, there are two factors which are at play. And will they just stop at Thailand, or are they now becoming more like an Indian company which is going to have presence in multiple areas, multiple countries? That's one change in terms of the business for Devyani. For me, that is a key takeaway. I think it's a surprise move. Second is the cost of acquisition. Look, there is Temasek was it. You just mentioned the numbers in terms of how much they are paying. So it does not look like a very stretched number in terms of valuations. But even though this acquisition will add significant amount of top line, the growth in Thailand versus growth in India, can that be compared? And if you are really going public, there are going to be naysayers who would say that, can you really manage, can one company really manage to risk or two parallel countries together? That time will only prove. So for me, it's a surprise move. Remember, Devyani is not a very cheap stock. FY25, it is trading at 60-65 times plus. So the scope for the management to get it wrong, I think, is very limited and restricted. Now, time will tell whether this acquisition is successful or not. But for me, in my book, I think this is a surprise move which has come from Devyani.
Okay, that's that on Devyani International. But what about ITC? What are the brokerages now saying about this one?
Yeah, we read those reports over the weekend that the largest shareholders, BAT or the British Tobacco Company, might look at trimming their stake from 29% currently, and they're okay to go down to around 25%. So the brokerages like Jefferies has actually written a note analyzing the possibility of the same. Now, they are saying that overall it is a bit of a possibility that this might happen because remember, challenges are something which the British Tobacco Council is facing at its own end. British American Tobacco, to be honest, is facing at its end itself. They are seeing declining cigarette volumes across its key markets, and even if you look at the ESG norms, they have made a pact that they aim to reach 50% share of smoke free by 2035. So to achieve that, this might be a step in the right direction, but it's not going to be easy, because do remember that there would be challenges that a global player cannot come into the tobacco industry, so it can't be a strategic stake sale in that sense. They probably might be looking at open market or giving it away in smaller chunks, because it does not look like a global player can come into the tobacco industry as a big chunk. Separately, they say the other thing that the company needs to think is that they themselves would not be able to increase their stake going forward given the norms which are there. So it will be a once and for all done deal with no reversible possibility. So that's something they have to evaluate as well. Secondly, they're also talking about the hotel business, because once it's demerged, they are likely to hold around 17%. But the kind of commentary that we've heard from the company BAT, it seems like they're not too keen on holding the hotels business as well. So there might be a bit of stake sale happening there. So for ITC, I think a lot of moving parts. Of course, the business is something which has been improving, right from foods to hotels and all of that. But this probable demerger, this separate listing, and of course what's happening with respect to the stake sale is something to watch out for.
So it's, BAT is looking at good market conditions, a reduced 4% ownership. Now, is 4% ownership by BAT something can markets digest? Well, if it is planned smartly in this kind of a market, I think there will not be a problem. So BAT is not exiting ITC. BAT is looking at reducing the stake by 4%. That's what we understand, again, source-based. If they do that, well, they've got back home problems in terms of what's happening to their own balance sheet, because BAT ultimately is a global British company. So it's like, okay, you need money and you made investment in a global subsidiary, and that global subsidiary is doing very well, you're looking at trimming your stake. So this is not like you're exiting out of ITC completely. 4% in ITC, if done over a course of a few months and few tranches, I think can easily be digested, because we are in a bull market, and ITC in a sense is now a outperforming stock. It is no longer a laggard. Beyond that, whether positionally they maintain their stake in ITC hotels and all, from a BAT standpoint, from a market standpoint, is not very large. So what this may do is that this may actually, of course, supply would increase in ITC in the next couple of days if the transaction goes through. But I will not read too much beyond that. Okay, why is BAT selling? I mean, they need money. They have a good asset and they're full right in a sense to monetize it. And market conditions are also so nice that if FIs are coming and if they really are getting good companies like ITC in large blocks, I think it's like a great time for them also to pick up. So for me, it's like just a market operation, frankly.
Okay, those are the two stocks on focus this morning. Anisha, thanks for flagging off those, Devyani International as well as ITC. On that note, we're going to take a very quick break. When we come back, chat stocks with Sanjeev Hussain. Back with the market right here in ET now, the SGX Nifty or the GIFT Nifty indicating a very, very quiet start once again. So some more consolidation in store it seems. But a lot of stock-specific news flow. And remember yesterday as well, while the broader markets held out, it was those news-specific stocks which were the movers in trade. And Happy Forgings is going to be launching its IPO today. Remember this week alone, you've got 7 IPOs. 3 kick-started yesterday, today is another one, and it is a book-built issue and will remain open for subscription till December 21st. Shrishti is here with all the details about this IPO.
Well, yes, Happy Forging IPO is opening today until 21st of December. The investors have a chance to go and subscribe for this particular IPO, where the price band of this IPO has been set from 808 rupees to 850 rupees. 608 is the overall issue size, but in that 400 crores is the fresh issue, where the company is planning to raise money to utilize around 200 crores rupees for the purchase of new equipment, plant and machinery. Another 190 crores is what they are planning to repay some of their outstanding debt, and they will also be using some money for the general purposes. Now let's talk about what the company actually does. So the company is into the industry of manufacturing heavy forgings and high precision and machine components. But to understand what are the segments and the revenue-wise contributors in this particular company, then commercial vehicle division contributes around 44%. Farm equipment contributes around 37% of their overall revenue, and another 16% is being driven by off-highway vehicles. So the auto component part is majorly driven, constitutes majority of its revenue contributor, but another 3% is what the company drives from the industrial division. Now the company has quite a history. It started from 1979 and is been into manufacturing of crankshafts, front axle carriers, steering knuckles, differential housings, and another products that are related to the auto space. And quite a good clientele is what the company is holding from the likes of Ashok Leyland, Mahindra, SML Isuzu, Swaraj Engines are some of their clienteles. But now, lastly, let's talk about the financials. So in the past 2 years, where the company has now started to report its numbers in a consolidated manner, we have seen a good jump coming in, where the revenue has seen a jump from 860 crores in FY22 to 1197 crores, and the margins have also improved from 26.9% to 28.5%, with almost 60 to 70% jump in their profit figure, where 209 crores is what the company has reported in their FY23 profit figure. So that's all about Happy Forging IPO, opens today.
Okay, let's also talk about what else is going to be keeping the markets focused. And, keeping with the IPOs, Credo Brands as well is going to be open for subscription today. And Vamakshi is here with IPO details on this one.
Well, yes, all eyes on Credo Brands marketing IPO. The IPO issue size is 550 crores, which is entirely an OFS, which means that the selling shareholders will be the ones that receive the proceeds, and it is not the company that will be receiving the proceeds from the IPO. Now, moving on to the shareholding, then the promoter and promoter group holding is expected to decline as a result of this offer for sale to almost 55.4%. Now, let me quickly take you through what the company actually does. It is predominantly in the Indian menswear category. In fact, it is one of the largest homegrown brands in the mid-premium and premium segments in the Indian market in terms of market share in FY22. They have in fact introduced the brand Mufti, which is now celebrating its 25th anniversary. Its range of products includes shirts, t-shirts, jeans, amongst others. In fact, they had a presence across India. They had almost 1,807 touch points as on September 23, and in fact this included 404 EBOs, 71 large format stores and 1,300 multi-brand outlets. Moving on to the company's financials, then they have seen a very robust trajectory, especially in terms of its revenue. Revenue has seen a growth of almost over 40% from FY21 to 23. Apart from that, the operational efficiency, and as a result its profitability has also seen a marked improvement. So definitely the company does have some strong financials as far as that is concerned. But moving on to the company's valuations, then FY24 PE ratio for the company, as per our calculations, assuming a growth rate of almost 20%, and the same PAT margins comes at around 19.4 times, which compared to some of its peers is actually quite reasonably valued. So those are all the important details for the Credo Brands marketing IPO, and definitely on the back of that, watch out for this counter.
All right, thanks very much for those details. Moving on, Apollo Tyres has announced a block deal, while Keynes Tech, KPI Tech, they have announced QIPs, which are all of these stocks that are buzzing and in the spotlight. Let's take it across to Sharad and find out all the details. Sharad?
Well, in the rising market over the last 2 months, we have seen a lot of PE exits happening, and over here we see Apollo Tires in focus. A block deal is likely to happen, where its Warburg Pincus's entity is expected to sell 3% stake, which is valued at roughly 850 crore or a $100 million deal. Now, looking at the floor price, it's coming at almost 440 rupees per share, which is almost 3% discount to the current market prices. Now, the Warburg Pincus entity is already holding 8% stake as per the September shareholding pattern, so there might be a 5% stake coming after this sale. Apart from this, the second thing is Keynes QIP issue opens over here. It's a 1400 crore QIP issue, and it's coming in at 2424 rupees per share. That's roughly a dilution of almost 10% stake in the company, with a discount coming in of roughly 7%. Now, of course, the proceeds of this fund will be used especially going into the semiconductor business. The third stock in focus would be KPI Green. 300 crore QIP issue opens, and the floor price is set at 1245 rupees per share, and this is coming in at a discount of almost 10%.
All right. Thanks very much, Sharad, for giving us that lowdown of all the stocks that are in the spotlight. Let's reconnect with our chartists and find out what are some of the movers in trade. And Nooresh, just going by the frontliners in yesterday's trade, what really managed to power through was select stocks. Bajaj Auto leading from the front, something like Hindalco as well up and about. What exactly are the charts of this, along with an Eicher Motors indicating in trade?
So Bajaj Auto is correct. Is a clean leader. It has made a slow and steady up move ever since it broke out above 4,300 levels, then above 5,000. So it's been a strong trend, and it continues to see no major correction as such. So in such a case, one could just keep a trailing stop loss below 6,200 and ride on to the position. So positive on Bajaj Auto, and the whole auto pack one by one has continued to do well. Eicher Motors also similarly, if you look at it, the stock has been a relative underperformer, but the stock has broken out above the highs of 2022, which is where it made a top around 3850. And it took a good enough pause around 3850 levels last month. And now we are setting up for a fresh move. If it sustains above 4200, it's setting up for a move towards 4500, 4600. So overall, the strength remains in the whole auto pack. At current levels, Eicher Motors and Hero MotoCorp still look interesting in terms of risk reward.
I'm just scanning through some mid-tier banks, and that's where you would say that now the rally has started coming lower now. IDBI Bank, Central Bank, Tata Tele Services. Not that you want to resonate with Tata Tele Services every time, because even though it's a Tata Group company, does not mean that it needs a special treatment. But 7% high for Tata Tele yesterday. IDBI Bank hit out of the park, and Central Bank also, it's really shot up on strong volumes. Nooresh, you can pick up anyone. Tata Tele, IDBI Bank, Central Bank.
So I'll go with IDBI Bank and Central Bank, because those are names where at least the liquidity is there and it's not on circuits as such. So IDBI Bank has retested that 60 mark, which was a problem for whole of 2021 to 2023. And even back in 2018, when there was an open offer or a period where it stayed sideways, went up to 75 very recently, came back to 60, tested it. So the base is strong here. If it can cross 70 to 75, that would be a major breakout. So the trend looks positive. Yesterday was a high volume day. So positive here, slowly and steadily it could trend higher. One would have a stop loss below 67, and it could even consider going long at current levels. Central Bank of India similarly has had a massive move couple of times, but has a tendency to see large corrections. So in last year also the stock fell almost 30 to 50% from the top. Very recently it fell from 55 odd levels to 42. So I would avoid a Central Bank of India, continue to go with the other names like a PNB or a Union Bank of India in the PSU banking space.
Are we reaching that stage where the real small PSU banks now will start flaring up?
Yeah, I think you can say that, Nikunj, because many of the PSU banking stocks, the mid-cap end specifically, I think these stocks were a bit more quiet or silent in terms of the price performance when the large caps were doing pretty well. So it's bound to be a rotation which is coming back into these names. And I think we've also seen good volume pickup. So as you were rightly mentioning that Central Bank, IDBI, many of the other PSU banking names, they've seen some good pickup in volumes. In fact, the two big underperformers from the PSU banking pack, not from the mid cap end, of course, the large cap names like SBI and Bank of Baroda. So there was a point where Canara Bank was one of the best performing PSU banking stock, and Canara and Bank of Baroda as well as SBI, both of them were significant laggards in terms of price performance. Even those laggards have managed to pick up pace as well as give signs of strong breakout for themselves. So I think we are in that phase where these underperforming mid cap, large cap names, they are the ones which are now looking very attractive.
Let's look at metals, Nooresh. Again, odd one out, but steel stocks off late, at least in last couple of days, have done rather well. Now, metals are coming out of a lot of consolidation, Nooresh, which means that are they getting ready for a big rally even in January 2024? Do you think this rally will extend?
So yes, we've seen a strong move in the Steel Authority of India, which is the one which had seen the largest correction in the laggard. So clearly that indicates a trend start. So in the near term, yes, it has moved up sharply. Did not expect it to do so. But breaking out of our 100, 105 levels, it's gone up to 115. But any retest to 105 to 100 band could be a buying zone for Steel Authority of India Limited. At the same time, there are other names which continue to do well irrespective of the cycle, which is Jindal Steel, which has not seen much of a correction in the whole period, but has gone up again, hit a new all-time high. 700 now should act as a base. So Jindal Steel looks promising. You have a Steel Authority of India Limited, and JSW Steel has gone sideways. So again, but that too has gone into a new all-time high. So overall, the sector seems to be turning around. One could look out for a selective trade in Jindal Steel, but one has to be careful in this sector with stop losses because whenever the trend changes, they tend to correct a lot as well. So overall, a highly volatile sector, but seems like a turnaround is in place, and one could go with names like Jindal Steel if one is looking out for a leader, or wait for a dip on sale to participate.
Kunal? JSPL, JSW, just the Jindal Group stocks.
Nikunj, I think I was looking at the Nifty Metal Index and the composition of the metal index. I mean, most of the large cap names are the formidable ones like Tata Steel, Hindalco, Vedanta, SAIL. They are nowhere close to their all-time high levels, but the Nifty Metal Index is confirmed a breakout of all-time high levels, I think 2-3 sessions back, and it's now up some 3-4% higher than the previous major highs. So it's the composition of, again, the significant amount of mid caps from the metal pack which have looked very attractive. But this could also bring in place the large cap stocks which have been huge underperformers. I think they could make a very strong and a significant comeback. For example, Tata Steel is something which looks attractive. The stock has formed an inverted head and shoulder pattern on the daily charts, and I would sense it should probably give a breakout of an all-time high level pretty soon for itself. SAIL has already confirmed a multi-year breakout, but I still believe that the stock has a long distance away on the upside, looking at the way the momentum as well as the volume surge has happened.
Rahul Shah as well is joining in on the show. He's from Motilal Oswal Financial Services. Rahul, thanks so much for taking time out. Let's get in a sense as to what your outlook is within some of the select pockets that have been in focus, in particular in yesterday's trading session. For instance, some of those shipping and defense stocks were abuzz. What's your outlook within this sector?
Hi, good morning. So I think the markets are into a real bull, and what we see is every day we see that some of the other sectors keep on outperforming, be it banking on one day, be it the IT on the other day, and a lot of news flow keeps on coming in, and the sectors just gets re-rated. So I think yesterday we saw all the shipping stocks and a few defense names, getting into it. Some global news coming out of it, and post that I think entire sector has got re-rated. So I think to be very selective in this kind of names in terms of the entire sector. And then I think if we talk about the defense sector as a whole, I think they have been, 3-4x or maybe more in some cases in last year and a half. So I think selectively all the stocks should do well going forward.
Selectively shipping stock should do well, or selectively stock should do well? Because stocks selectively always do well.
So I think very few select stocks, like say maybe on the PSU sides, I think they've done very well. So in that space, I think we continue to remain, I think, positive on that side, like stocks like I think Cochin Shipyard, or maybe in the stocks like maybe on the defense side, BL. So there's too few names have been positive on it.
Nooresh, specifically on shipping stocks now, I'm going to pick it up, and I'm keeping defense away. purely shipping stocks, given what's happened, I mean, it's a bit of a, I mean, not a geopolitical concern, but yeah, a bit of a, militancy issue in Red Sea. Because of that, all shipping stocks yesterday went higher. Is there merit in looking at them, let's say GE Shipping, SCI?
So we barely have a couple of stocks in the large cap space or tradable space in the shipping sector. One is GE Shipping, which continues to be a very slow and steady trend. So it doesn't have strong trends. So the stock has moved up over the last 6 months, say from 550, 600 to 900. But we do not see a single day move of 10% as such. So the stock does not sustain. But yes, it's been a slow and steady trend. So that's been the best place to participate. Shipping Corporation of India, on the other hand, keeps having further news in terms of disinvestment, etc. But technically, the chart has started looking interesting because the last few times the stock has always faltered around this 150 to 160 mark in the last 2 years. And we've come above those levels, hitting a 578 year high on the stock. So SCI looks promising on a technical structure, good volumes over the last few months as well. So one would have a stop loss below 155. And this could surprise on the upside, irrespective of the shipping moves happening around the globe. The technical chart structure is a huge breakout in the making. So I would go with SCI at current levels.
Right. Meanwhile, Rahul, just wanted to get in your take as to what you've made of the Zee-Sony merger now, almost perhaps being at the brink of a collapse with the timeline, looking like it may not be really extended for the merger. How are you reading into the story as to how it's unfolded and the updates that we've gotten so far? What does this spell out for Zee Entertainment?
So I think very difficult to comment on this terms of where the merger will happen, not happen, and what the story will be. So I'm not an expert on that perspective, but I think where the stock has been, and I think looking at the way the franchise network, and if this goes through, I think easily, then I think there will be a huge upside in over a period of time as the entertainment. So I think looking at current valuations, if you're an investor, and I think offers value at current levels, and maybe if you look at peak historic valuation versus in last 6 months or a year, the way the stock has been. So I would suggest, I think if you're an investor, one should look at it buying a stock at this current levels.
What will you do with IRDA now going forward, Rahul? Do you think there is merit in booking profits, or one should still ride the happy journey?
Sorry, which company?
IRDA.
So very difficult, but I think I would advise to levels.
Say book profits, when House of Motilal Oswal says book profits, awaaj bhi drop ho jata. I think we lost your audio there. Did you say book profits?
Yes, I said book profits. So I think stock has done quite well. I'm sure you know about it. And I think going forward, we feel that a lot of other stocks and the entire other sectors, and especially in the financial space, looks quite promising. So I think one should look at booking profits at these levels. That is what we feel.
That's the hallmark of Motilal Oswal, always bullish, right? When their experts recommend that book profits also, the natural audio drops. So when Rahul had to say IRDA and book profits, the audio actually dropped. So I don't blame it on Rahul, but that's the way the positioning is of IRDA. 110 rupees. I mean, what a multi-bagger it's been. 32 rupees, 33 rupees over the IPO price, went to 120, it's come down to 110. I'm going to change gears and talk about metals, and especially ferrous and non-ferrous. Rahul, which is a better bet according to you, ferrous or non-ferrous or non-ferrous?
So I think if you look at the entire sector has done well. Ferrous and non-ferrous both has done well. So going forward, I think if we see yesterday's that deal coming from by the Nippon buying out of that US steel company, I think that deal has come out. Nobody was aware about it that it came off yesterday, and obviously premium to the market price. So I think we might see globally all stocks have done well, and obviously domestically also looks like that. I think all the steel companies definitely would benefit and would do well. So, and I think if we see in last few sessions, if you look at it, I think PSU names in a steel companies also, and as I said, that entire sector has done well. So I think steel basically looks promising to me. And if you look at SAIL has done well, moved up 15% in last 15-20 days on Nalco or so on and on. So my preference would be JSW Steel at this levels. I think the stock reacted a little bit negative, but I think offers value at this level, and that would be good upside from current levels from here as well.
There's been so much policy flip-flop when it comes to the entire sugar basket. The stocks have certainly been a buzz of late. What's your outlook, Rahul, as to what this news spells out in the long term for sugar?
So we've not been covering any of the sugar stocks, so it would be difficult to comment of any of them.
All right, how could we miss this? Himachal Futuristic 5% higher, Zomato 4% higher. Nooresh, 130 rupees for Zomato, up almost 100% for a stock which got bashed, which got hit, which was bleeding at the beginning of the year. Now today is going to be all set for a grand year.
So this is how trends are. They continue to surprise when they start. In the same way, the stock was at 130 exactly sometime around this point of time in 2021. And we saw almost sub 50 levels, almost closer to 40. And that too for almost 6 to 12 months. And now we are getting back to the same prices. Now it is getting into a tough territory because post-listing, the stock was in a range of 130 to 145 for quite some time. And then did a little bit of a spike to 160 and then topped out. So at 130 to 145 would be a zone where it should ideally face a lot of resistance. So actually a time to book some profits here, or rather take the full money off. The whole move is done from the bottom of 55 where it gave a breakout. Could see some bit of a price consolidation here, an even time consolidation. As the stock breaks out 150, 160 really quick. So time for some pause at 130 to 145 back.
All right, fair enough. That's pretty interesting. Meantime, let's also get in a take from you, Rahul, as to what the outlook is when it comes to some of those IT stocks, because the comeback that we've seen within the IT space has been fairly commendable. But the question is what the next year really spells out, particularly when it comes to large cap IT. Is there merit in looking at these names?
So I think large cap IT companies, I think if we look at it, have underperformed the mid cap IT companies. If we look at broadly in last year, year and a half. So I feel that the stocks have just been flat or maybe 5-7% plus minus if we look at absolute returns in last year, year and a half. So I think if I have to look at it, large IT companies positively looks quite promising from it. Maybe just to give you a perspective, I think TCS obviously in the large cap have done nothing in much in last few months, and but looks like I think way the earnings guidance will come to this quarter, and plus way the performance has been, I think way the deal pipeline what they have. So recently only you saw that the second largest deal in which they did it. So I think my sense is I think all large cap IT, the risk to reward is quite favorable, and when you have market scoring high, then I think all the sectors tend to move up, and I think this sector has underperformed vis-a-vis others. So it looks like I think that all large IT names like TCS, Infosys, HCL, all should do well from current levels.
Okay, fair enough. That's the view coming in. Meantime, Kunal, let's get in your take on the charts. What's the outlook on IRCTC as well as JK Tyre?
I think it was a phenomenal move for IRCTC yesterday. The stock moving from sub 800 levels to I think at a point where the stock was on the verge of retesting or breaking past about the 900 mark. It was a phenomenal comeback for the stock price. And I think I was making this point yesterday. The stock is trying to get into a covering up of the huge underperformance with respect to many of the other railway names. So I would believe that this stock could probably see a further leg up, at least 100-120 point further up move from yesterday's closing is what I would expect. So closer to 980,000 approximately could be a near-term target range for IRCTC. Would be bullish on the stock. May not be seeing an immediate rise, because after such a kind of a 10% up move approximately yesterday, the stock tends to go into a pause for a couple of days and then gets into a follow-through price up move. JK Tyre on the other hand, I think from the tire space, this has been one stock which has moved into a very strong and a consistent uptrend as compared to Apollo Tyres, Balkrishna Industries. These stocks had a knee-jerk price action for themselves. They've had their fair share of correction. I think JK Tyre has been more consistent in that aspect. The stock had broken past about the 365, 370 mark a few trading sessions back, formed or rather completed a bullish flag formation on the daily charts. So looks attractive. Not initiating any trade on tires, but yeah, I think if the stock retests the levels of 365, 370, it could be a good time to enter the stock.
Rahul, what is your sense on some of these railway names? While of course they've had their time in the sun year to date, but some underperformers like IRCTC are now, perking up double digits on just, on the minute bit of positive news flow.
So I think one broad theme, if we look at obviously the PSU pact getting re-rated and the valuations getting a little bit better. So I think that the broad theme is obviously, I think one is that I think PSU stocks getting re-rated. So I think fairly, if you look at it, I think in the railway or maybe in this kind of this thing. So we've seen this we've seen this kind of
Snap that line with Rahul. Just going to get back to him in a second from now. But yeah, IRCTC was the big one yesterday. A digit move closed in at the highest point in the day with a 12.5% uptick coming in. There were, of course, other movers like Indiabulls Housing Finance, which, of course, Kunal has already given a buy on, held up by about 4.5%. There was Hindustan Copper, Zydus Life, Siemens. Interesting bunch of names out there that actually perked up. The other one, of course, Reliance. A 1% move. But Nooresh, what is your sense? Can we see a meaningful move from here?
Yeah, so we could actually be looking at a retest of the previous highs closer to that 2600, 2650 mark. The trend is finally picked up. We've crossed almost the last 3-month highs. The last time it broke down was below that 2500 mark. We've crossed above that 2500 mark, and now we could go towards 2600, 2650. So I would expect it to make that move over the next few sessions. So Reliance could lead and continue to hold on the markets as such. So it's a buy around this 2500, 2520 would keep a stop loss below 2480 and have a target price of 2650 in the short term.
Right, okay, let's move on and let's talk some of the individual names as well. And Westlife Foodworld's management meet is currently in the spotlight as Axis Capital has noted down some of the key takeaways. Let me take it across to Gaurav and get in all the updates here.
Axis Capital met with the management of Westlife Foodworld, and there are some updates we have in the QSR space itself. So as you said, QSR space, the entire demand in the QSR space has been slowing down, and company specifically saying that they are also seeing the same thing happening in their company. So we know that Westlife Foodworld is known for its brand McDonald's, and they see that there has been a reduction in the average check value for their restaurants despite the footfall being at the steady state. They have also reiterated that they will open 40 to 45 new restaurants in the year. I mean, out of which most of it has been done already, and after this store count is going to be at 380 odd numbers in FY24 itself. Despite this, they are expecting now, Axis Capital is actually expecting the revenue to grow almost by 7% for the company. But let's also talk about the cost and the other margins. So the raw material cost has been going down, and according to Axis Capital, this is going to boost their raw material component and gross margins. But despite this, we might see some kind of decline in EBITDA margins as well as in EBITDA because of the slowdown in this growth. And there are some negative cues coming in for the company, but Axis Capital believes that Westlife Foodworld is actually continuing to invest in network expansion, menu innovation and cost efficiency measures. That is going to lead to some kind of positive outlook for the company, and that is why they have maintained their ad rating, and but at the same time they have cut the target price to 900 rupees per share.
This is such a strange year that banks have done better than IT. IT has done better than banks. It should have been the other way around. Banks have a clear visibility. IT does not have that clear visibility. That's yesterday's IT. So YTD, that's yesterday's bank Nifty. Let's look at the YTD change for the index, the IT index and the banking index. And that's where you would actually see the change. There you go.
10.5%, less than 10.5% for Nifty Bank, Nifty IT, 25%.
What is the lesson to be learned here? Consensus never works. I mean, everybody was like, oh, IT, so it's a bad year. Profit guidance cut, order book weak, hiring frozen, US economy, AI, if that was not enough. And NASDAQ has done well. Yeah. NASDAQ has given you bumper returns. IT has given you 24% return. Banks, everything was good. And yet the index has given 10%. Will it reverse next year? That is something which, let's see if it happens or not. Rahul, which is a good non-IT services stock you like? When I say I'm keeping the traditional large cap and mid cap IT services company aside, do you like anything in the product space? Do you like anything in the niche IT space?
So I think predominantly we like large cap IT names more than the product side or maybe on the services side. So I think the heart will still remain on the large cap IT names, and I would stick to them at this juncture.
GIF Nifty, when we when we walked into our office early morning 7:30, the GIF Nifty was flat. Now it's up. So I don't think you can read too much into the GIF Nifty per se. What is interesting here is that you've seen an extreme of everything, extreme momentum, extreme in terms of market positioning, and also extreme in terms of where the size and the quantum of the rally is. And such extreme situations do not exist. So either it will reverse or it will hit a pause. So I don't think we are in the last lap where this will end badly. I don't think we are in that phase of the market. But we are definitely in that phase of the market where if you book some profits, if you switch gears from small cap to large cap, or if you just simply sit on 10-15% cash. And Rahul Shah feels that if you have IRDA, maybe first time in my life I've heard somebody from Motilal Oswal say that book profits. When did you use the word book profits last time? Nobody in Motilal Oswal is authorized to say this, right? Book profits. Market kharab lag raha hai.
Senses, as you rightly pointed out, one thing is very clear that I think one needs to shift gear from from mid caps to large. So
Rahul, see, every time when we are talking about booking profits, even the lines know that you're not supposed to book profits as advice from Motilal Oswal. First your audio dropped and now the video is frozen. So we'll get you back with maybe a bullish question. But let's fix his audio, please. Then let's fix his video. First audio was down, now video is back. Every time I've asked him a question, I asked him, what do you do in IRDA? He said, look, book profits, and the audio dropped. But then I realized it's from Motilal Oswal. Motilal Oswal folks are not supposed to say book profits. It's in the DNA. Even
the airwaves can't handle that.
Exactly.
But yeah, Rahul, you want to finish your point on IREDA? Okay, we will get to him in just a bit. That's the stock then in trade for you. 110 is where it shut shop. But Kunal, what about its peers? PFC, REC, time to book profits there too?
Well, I think it's more like an unstoppable rally for these names. I've not seen this kind of a rally for PSU stocks like PFC, REC for quite some time. In fact, for the last 10 odd years, these stocks were consolidating, and from the time when REC PFC got into that 250-300 mode, that was the first point where the indicators went to an overbought territory. But then these stocks, rather than going into a major price correction, actually went into a mild time correction and then continued to move up hard. So it's very difficult to try and time a top as well as a major overbought phase into these names. We'll have to wait out for a point where these stocks start to correct at least by a margin of 5% to 7%. That will be the first trigger where we may probably ascertain that some sort of a major top is in place. As of now, it doesn't look like, and this probably indicates that this momentum will continue for the stocks.
You'll also saw an excerpt of a conversation we had with Abhishek Lodha a couple of days ago in terms of where he feels real estate is moving. Real estate is another sector which in a sense has just been coming back, and it's just been coming back like an absolute charm per se. Nooresh, the same logic of booking profits, will it apply for real estate as well?
Yeah, so in certain names, yes, the stocks have moved up really quick and really large. So in that case, one could look to book profits across the board. So whether it's a DLF or a Prestige, one can book profits over there. Something like a Godrej property not reclaimed the previous high, so maybe that has some upside still left. But a lot of these names have gone up 50 to 150% in the near term in the last 3-4 months. So time to book profits. And we've seen these stocks have a tendency to then go sideways for a long period of time. We've seen Brigade Prestige be sideways for almost 2-3 years without any price action. So after such a move, it's time to take profits of the trade.
Right, okay, that's the take coming in on where realty may be headed. In fact, if we can just toss across to that soundbite, the conversation that Nikunj had with Abhishek Lodha, we'll just do that in a minute from now or so. But yesterday, Godrej Properties, which was actually a laggard, was down about almost 3.5%. Let's address some of the other stocks which are going to be in focus this morning. And we've got all eyes on Devyani International, especially looking at the diversification that they are making and the expansion, wherein now they are opting for some franchises in Thailand as well. By the way, CLSA 2 has come out with a note on Devyani They've given it an outperform, saying that they will pay 341 crore rupees for a 50% stake for the restaurant development company. Temasek Holdings will be taking a 48% stake at a local Thai partner will be taking the rest. So that's the move coming in on Devyani International. We're going to be keeping our eyes out on this one once the pre-open rates actually trickle in. That said, the texture of the market, like Nikunj was just pointing out, wherein year-to-date banks have actually underperformed the Nifty IT. But Kunal, just to take that point forward, within the Nifty IT, like you were saying, there's a KPIT and persistent on one hand, and then of course there's been some contribution coming in from TCS Infy as well. What's going to lead the next leap forward? Will it continue to be the winners from the last year, that's persistent KPIT, or do you see now newer horses coming to the fore?
See, I think one thing is certain, that when a trend on an index re-begins or reshapes for itself, when there's confidence rather which comes back into a sector, even the laggards at some point of time, they would get into a covering up of the huge underperformance. Just for example, we were discussing railway stocks, that there was a point where IRCON, IRFC, etc., these were the names which are moving up higher, and IRCTC was underperforming, but now we've seen that stock also trying to cover up the underperformance. So I would probably sense similar reaction coming on from the IT stocks. Yes, there was a point where persistent, KPIT, mid-cap names like Birlasoft, etc., they were doing exceptionally well for themselves. But I think, it was high point for the large-cap underperformers to make a comeback and to cover up the huge underperformance. And we are at a point where Nasdaq is just few points away from its lifetime high levels. The Nifty IT index is yet to break past about the life high mark, and many of the large cap names, the likes of I think TCS, Infosys, Wipro, etc., significantly off their lifetime high levels, which means that these stocks have more room to move up higher. So I would be bullish on the large cap IT space particularly. Yes, there may be few odd pauses or corrections in between, but I think largely the trend for these stocks is far bullish than what it was maybe a few months back.
Okay, let me also get in some mid-cap trading ideas on that note. Nooresh, what's on your list?
So that would be a buy on Motilal Oswal Financial Services, the stop loss at 1170 and a target price of 1400. We are seeing a breakout across the whole sector as such. We've seen smaller names do well. Motilal Oswal has finally reclaimed the highs it made in 2021 around the 1200 mark, went through a very deep correction all the way down to 550, 600. So the stock looks like a 2-year breakout, and it has consolidated around this 1200 mark for the last 2 months. I would expect a fresh move and even go higher towards an all-time high towards 1600 as well.
Right. Kunal, what about your mid-cap strategies?
I'll go with the buy on Patel Engineering. That's a stock which formed a classic bullish flag formation. What attracts in the charts is the huge jump in volumes over the last, I think, 4 or 5 days for the stock price. So would suggest a buy with 74 as a target, stop loss at 60.
Okay, let's move on and let's tell you what's the buzz on D Street. Thermax, it seems, is going to be in focus as the company is now beginning to get higher inquiries for the zero liquid discharge segment, and large orders from institutional clients are also on the anvil. Sharad is here with all the buzz. Sharad?
Well, yes, the buzz in the street for Thermax is that increased inquiries are coming from institutional clients, especially in the water business for the zero liquid discharge segment. Now, interestingly, also there's another buzz that a large order might be coming in for the water business project as well. Now, there was a recent analyst meet also where the management had stated that the entire focus would be moving from the low margin business, especially coming from the government as well as the municipal orders, to much more process oriented solutions. Apart from this also, if you look at it, the water business has tripled over the last 3 years and currently standing at the 1000 crore mark in terms of the revenue contribution. And lastly, I'd also like to point out that the margins which was there in the water business, analysts have stated that that was ranging between 4 to 6.5%, and going ahead is expected to go up more than 7%. So Thermax would be in focus today.
All right, Thermax in the spotlight. Thanks very much, Sharad, for those details. We'll slip into a quick break and be right back.